The fallout from the leave vote in the referendum has been pretty serious, both economically and politically, of course. Economically, we've seen a dramatic drop in sterling, and we've also seen significant volatility in share prices. Politically, we've seen both of the main parties in complete disarray. But I want to talk about the potential impact on taxation that the leave vote might have, and we can only look really in the near term at that. Now, the context for any tax change would probably be a budget, and it's been called an emergency budget, but by the time we have it, which is going to be after the election of the new Conservative leader and de facto Prime Minister, it's going to be early September. September the 9th, to be precise, is the date we'll have the outcome of that vote. And the budget, if we have one, will follow sometime after. Now, what we have here is some volatility also in tax change predictions, because we've got two ends of the volatility scale to consider if we continue with that analogy. We've got the austere end and we've got the stimulative end. The austere end was really started by George Osborne ahead of the referendum, when he said, effectively as part of the Leave campaign, if we have a Leave vote, we're going to have a 30 billion hole in public finances, and we're going to have to close that somehow. And we're going to do that, broadly speaking, by £15 billion worth of benefit cuts and £15 billion worth of tax increases. And he talked about increases like the 2% to 3% increases in basic rate tax, higher rate tax and inheritance tax. So at the austere end, which I'll look at first, we had that. We've also had some talk, possibly by other commentators, of maybe those CGT changes, which weren't really called for by the population at large, but were quite generous, could maybe be reined back, and no one would moan too much about that. And of course, there is that very lucrative 30 odd billion that's spent on pensions tax relief, which many of you will know and have read about. Of course, we didn't have any change in the last budget in March earlier this year, but that could be up for change. Now, it probably wouldn't be immediate, that one, because we're likely to have a new chancellor. We're not definite, but we might, post the election of the new Tory leader and Prime Minister, and we almost certainly would have a new pensions minister. And so I think there'd be a bit of taking of stock before there was any significant pension change. But that sort of change could be introduced without having a dramatically austere effect on the economy, a depressing effect, because the better view is that maybe more than an austere budget, we'd be looking at one that was more slanted towards stimulation, because the Treasury figures and reports that we've had both pre and post referendum indicate a very big hole in government finances because there just hasn't been the growth that was expected. So if we look at a broadly stimulative budget, then we would see perhaps not those personal tax increases that was talked about before the budget. The Chancellor very recently has talked about a very big stimulation, which is a dramatic reduction in corporation tax, because he's looked at reducing corporation tax at below 15%. We've got an Irish corporation tax at 12.5%, Irish corporation tax rate at 12.5%. So there is precedent for it. Some have said that wouldn't do too well. It would prejudice the negotiation with the EU as to what kind of deal we got if we immediately went to become a low tax environment. So-called tax dumping, said the head of tax for the OECD. But that's something that is definitely on the table. And in other tax news, which is not necessarily stimulative or austere, is the quite important changes, and there were some others as well, but I just want to talk about the changes that were proposed to come in from 2017 on the taxation of non-domiciles. Quite important ones, because we've had 15-year deeming of domicile for anyone that's had 15 years of residence in the UK for all taxes, not just inheritance tax, and a coincidence, a bringing down of the 17-year period for inheritance tax to 15 years, and also rules to prevent so-called enveloping of UK-sited property. So if you're a non-domiciled individual, own a UK property that's your residence, put it in an offshore company, and suddenly it's an offshore asset, which isn't subject to inheritance tax, and some other changes too. So some quite important and dramatic changes in relation to the taxation of non-domiciliaries, largely bad from their standpoint. Those changes were put sort of on hold, development of them, because it's still in consultation, the legislation's being developed, with a view to it being in the 2017 Finance Bill. To our knowledge, nothing more has been done in that on that because of the Brexit vote and everything that followed on from that. There is now great pressure, we understand, to move those changes on to 2018 to give a little more time to consider them. So when we consider that, the two ends of that tax prediction volatility scale, we've got the austere end, which most people feel is unlikely, except there could be some not near-term but medium-term changes to pensions. And then we've got the stimulative end, particularly with the corporation tax change that was indicated by the current Chancellor, at least, to present Britain as a place to do business, to prevent businesses leaving Britain if passporting rights become a little harder out of the EU negotiation. It will be a statement that this is a good place to stay and do business. The one thing out of all of this tax uncertainty, as well as the economic and political uncertainty, is the fact that the one certainty is that people absolutely need advice. This is the most important time for financial advisors to be well informed, to be reassuring, to give their clients that right advice. And we'll be doing all we can within Techlink to give you the raw material to be able to give that advice. So keep an eye on the bulletins.